We began this course by defining wealth as the amount of money that we need to be free. Free to do what makes us happiest, with who matters most, all on our own terms, for the rest of our lives. That's because time is our most valuable resource. Most things we value, like money and material things, are infinite. There's always more of them, but there's no way to escape the power of time. We only get so much of it. We reinforce that wealth is the goal, not money. Money is simply a tool that we can use to get what we want most. This is important to understand because on its own, money lacks value. You could have all the money in the world, but if it doesn't represent experiences or things that matter to you, what good is it? It's just a number. We invest because it puts our money in a position to work for us, instead of us having to continue to work for it. This is important because in order to build wealth, our money not only has to keep up with inflation, it has to grow at a rate above it. We saw that if our friend Bob needs to accumulate $1 million over 40 years to live his dream retirement and never invested at all, he'd need to contribute the entire amount, an average of $25,000 per year. But if he was to invest and earn an 8% annual return over those 40 years, he'd have to contribute less than $3,600 per year, or $143,000 in total, allowing Bob to contribute over $21,000 less per year to reach the same goal. Investing allows us to spend more of our time, our most valuable resource, in our most ideal way. In our example, Bob has over $21,000 per year that he doesn't have to contribute, meaning he has more flexibility and more money to pursue what matters most to him. Trying to save $25,000 per year for 40 years likely would have required work being his top priority. Investing properly can turn average inputs into extraordinary outcomes. By understanding the difference between investing and gambling, we can remove luck from our equation and put ourselves in the best position possible to build wealth over the long term. Investing properly is putting our money in a position where we can reasonably expect it to have a higher value in the future. Gambling is putting our money in a position where all we can simply do is hope that it will have a higher value in the future. We want to remove luck from our equation and approach investing in a systemized way. Investing properly is safe and eliminates any reasonable chance of losing all of our money, where gambling puts our money in the riskiest position. If we try to force long-term results over a short period of time, it rarely goes how we hope it will. A world where a properly diversified and invested portfolio drops to zero is one where every company around the world has gone bankrupt, every government around the world has failed, and money has no value. If this ended up being a reality, money would be the least of your worries. When we invest money, we become partial owners of the companies and assets that we invest in. That gives us the right to share in the success that they have. When we invest successfully, our investments increase in value. The opposite is also true. So we want to invest in a way that we understand or in companies that we believe in. We generally have 4 types of assets that we can invest in: stocks, bonds, real estate, and cash, each with its own behavioral characteristics, creating their own pros and cons. Although there are many ways that we can invest, the most important thing is that we do so properly, in alignment with our risk tolerance and goals. One of the ways that we can better understand investing is by making it more relatable. By comparing investing to taking a road trip or something else you can find connection to, we can make it relatable. In our example, your destination becomes your financial goal, what we're ultimately working towards. Your vehicle selection becomes the account you'll use to get there. Your passengers become your investment style and professionals you use, and your route becomes the investments you choose to get you there. Remember, anything complicated can be stripped down to easy to understand components. Our goal as investors should be to invest properly for as long as possible. I wouldn't be surprised if no one ever replicates the success that Warren Buffett has had, but we can do our best to imitate it. By investing for a long period of time, our assets will grow in the same pattern as his, just on a different scale. Remember, time in the market matters more than timing the market. Since we want to invest for as long as possible, we need to approach investing in a way that gives us the best chance for success. This means starting sooner than later and doing the right things from the very beginning. We want to focus on things that are within our control and ignore the things outside of it. The biggest contributor to our long-term success is our portfolio's diversified asset allocation, or its mix of stocks and bonds. Instead of taking big bets and trying to maximize returns in any given year, we want to invest for as long as possible, getting great returns in all of those years. We never have to be the best investor, we just want to avoid being a terrible one. We also need to think about our money and not only its present value, but its expected future value. Using the rule of 72 can help simplify this thought process. Based on historical returns, we should expect our investments to double about every 10 years. The main driver of our expectations are our own experiences and the experiences of those around us, regardless of whether or not those experiences are reflective of how things really work. Moving forward, based on an inaccurate picture of how investing works, can be dangerous, because we can't know what is reasonable to expect. There's an underlying idea in a lot of books that I've read about investing and decision making. It's that during our lives, we will experience a lot of things for the first time, but it's highly unlikely that it's the first time that thing has ever happened before. In order to establish realistic expectations for the future, we have to understand what has been normal in the past. If we know what has been normal, we can have an idea for what might be normal moving forward. By knowing what we should expect to happen, we won't be surprised or panicked when those completely normal things do happen. We want to disconnect our expectations from how we want the world to work, and instead, align our expectations with how the world actually works. This chart shows return data for different asset allocations between the years of 1926 to 2022, based on the U.S. stock and bond market, highlighting very well the relationship between risk and reward. Past returns don't guarantee future returns, but this data can give us an insight into what we might expect moving forward. The longer we invest for, the better our results become. This chart shows the range, spread, and periods of negative returns over time. One of the best things that we can do as investors to establish realistic expectations is to understand how often and to what extent markets are down. Here's a chart showing the bond market over the past 44 years, with only 5 negatively returning years. Returns are often within the range of 0% to 10% up. When compared to a chart showing the S&P 500 historical returns, we see something quite different. The data almost looks random and unpredictable, highlighting the volatility we can expect from stock or equity markets, while showing higher returns, aligning with the idea of risk and reward. The more risk or volatility, the higher our long-term expected return becomes. Regardless of the annual return, we see that every year experiences a significant drawdown. Historically, about 65% of years experience a drop of at least 10%, and about 25% of years experience a drop of at least 20%. So volatility is completely normal and should be expected. We can also see that in every year, we have a higher chance of it being a positive year than a negative year, showing that regardless of what's happening, it's always the best time to be a long-term investor. Bubbles are a natural occurrence that happen when prices get disconnected from reality, and can take two forms, market-wide or concentrated on a specific company, industry, or country. Market-wide bubbles are unavoidable. Concentrated bubbles should be avoided at all costs. Market-wide bubbles are unavoidable because markets follow the overall business cycle of expansion, peak, recession, and trough. Bubbles may happen for different reasons during different periods of time to different people and in different places, but the behavioral patterns in every case are nearly identical. Endless excitement over something new leads to incredible demand, skyrocketing prices with each purchase. Eventually, there's a mass realization that what has been happening isn't sustainable, and everyone sells to try to get out ahead. This crashes the price, leaving whoever's left holding likely looking at an incredible loss. Bubbles have been happening for centuries and will continue happening for centuries. How you fare during them will depend on whether you're able to remain level-headed or if you get swept up in the craze. Markets behave differently during different phases of the economic cycle, as shown in this chart. Understanding how they've moved can help us avoid making a disastrous decision. When markets drop, our gut usually tells us to sell and get out. But as we can see, that's exactly when markets perform their best. It isn't a question of if our portfolios will drop significantly, it's a question of when. But if we understand what has been normal and what's reasonable to expect, we can make our response to what happens the best version of itself. Here's a chart showing Wall Street predictions for the past 25 years. Their track record has been terrible. If someone guessed that the market would be up 10% in each year, which is more or less its long-term average, they would have been closer than the experts. The truth is that no one knows what will happen in the future, so expert opinions can't be taken more seriously than a guess. When it comes to market predictions, we can only be sure of two things. One, that people will continue to make them, and two, that they will continue to be wrong. Investors often measure their success by the return they get. But if markets are as volatile and seemingly random as they are, it's impossible to give a blanket answer as to what's a good return. A 10% return in a year when markets are down would be incredible, but a 10% return in a year when the markets are up 30% would be a letdown. Using returns as our measure of success relies on a single variable that is outside of our control, making us feel a false sense of confidence when things go our way and powerless when they don't. It's setting ourselves up for a stressful and disappointing reality. Instead, we want to focus on things that matter and are within our control. What history shows us is that if we have the correct process, then the end result we're looking for becomes inevitable. It's about doing the right thing and doing that thing right. In order to end up where we want to be, we have to begin with and move forward with the end in mind. Only by knowing where we want to go can we build a plan to get there and measure our progress along the way, ensuring that we're always moving towards what matters most. Effective planning puts us in the mindset of being able to use discipline to choose between what we want now and what we want most. There's a huge difference between something being simple and something being easy. Investing can be pretty simple. All we need to do is regularly contribute to our investments, have them invested properly, and not touch them for a very long time. But it's clear that that isn't easy by looking at how many people fail to manage their finances effectively. A lot of our challenges to plan effectively come from our default thinking. We naturally anchor ourselves to the present, prioritizing the now instead of daydreaming about the future. This once helped our ancestors survive, but now it distorts our perception of the future and often leads us to making decisions that we later regret down the road, once whatever was going on has passed. We prioritize our present self over our future self, resulting in us often making the convenient choice over the correct choice. We're more likely to procrastinate the things we know we should do, hoping that our future self will want to do them in the future. And even though we've changed a lot in the past, we envision our future with very little change. The default setting of our brains are designed to prioritize the present rather than the future, and this can make planning difficult. But the solution aligns more so with minor adjustments than a complete overhaul. When our options feel numerous, or we're overwhelmed by what to do, we can simplify things by thinking about what needs to be true for the opposite to happen. If our goal is to build wealth, we can think about what would have to be true to avoid building wealth. We would spend more than we make, we would accumulate debt, and we'd never invest. So if we spend less than we make, stay out of debt, and start investing sooner than later, we're tackling most of the problem. One of the easiest ways that we can change our defaults is becoming more familiar with our future self. Our default is to view our future self as more of a stranger than a different version of ourselves. This puts us in a position of making decisions in the present for ourselves or for a stranger. No matter how good of a person you are, you're going to choose a loved one over a stranger every time. In order to bridge the gap between a complete stranger to a loved one, we need to think of our future self as extensions of who we are today. Sure, we will change over time, but we will share a lot of things in common, and what we share is more important than what changes. The closer we feel to our future selves and the type of person we want to be, the more likely we are to do things for them. We can bridge that gap by thinking about what we want our future to look like, how we'd ideally spend our retirement, and what would get us excited each and every day. In the beginning, Our shift in decision making is intentional, but with enough time, it becomes automatic. Defining our goal allows us to measure our current effort towards that goal to the effort required to achieve it. This can let us adjust our effort to ensure that we arrive on time and as planned. Instead of hoping things work out how we want them to, we want to actively make it happen. The sooner we can identify this, the smaller those adjustments are. Even just getting 1% better each day results in us being 37 times better at that thing over a year, a 3,700% return. When we invest properly and put our money in a position to work for us, instead of us having to work for it, it puts us in an optimal position. Since our goals require less of our money, we have more money and more time to pursue what matters most. It puts us in a position of not just trying to optimize our future, but trying to optimize our entire lives. Instead of waiting until we retire to do what we want to do, we can identify what matters most to us and when the optimal time to do those things are, understanding that everything requires a mix of health, wealth, and time, and that certain things are best optimized at different times of our lives. We don't want it to be just about the destination. Realistically, we'll be working towards our retirement every year of our adult life. That's far too long of a time to not completely enjoy the journey in getting there. We need to find balance between investing for our future and finding fulfillment for our present self, because life is meant to be enjoyed the whole way through. What if the best thing we can do is find meaning and purpose in everyday life? Having a sense of purpose can really shape someone's life. When we feel compelled to do something, we're going to do more things that ensure we're able to do that. We see proof of this in blue zones across the globe and best-selling books. In order to make meaningful and sustainable change in our lives, we want to start with our purpose, and we want to lead with the identity of the type of person we want to become, the type of person we believe we already are. This way, we're not going through aimlessly. We have a purpose behind our actions and our decision making. When we don't know what matters most to us, we can be convinced that just about anything could make us happy. But when we have a clear set of purpose and we know what matters most to us, our daily actions and the decisions we make can reflect it. When we're stuck at a crossroads between two choices, reflecting on our values can make the correct choice clear and obvious. This way, we can always work in the direction that matters most without feeling like we're making needless sacrifice. Everything we sacrifice today moves us closer to what we want most, but we have to understand what that is. Considering this doesn't cost money and can be the trick we need to make it all work, it has to be the easiest thing we can do to live a purposeful life. To help increase the chance of our long-term success, we want to make the actions we want to take as easy as possible. This requires us to automate as much of the process as possible to reduce any resistance or friction between us and what we want most. Instead of prioritizing savings and investments last when our paycheck comes in, we want to prioritize it first. This does a couple of really important things. It prioritizes our financial goals first and gives us the freedom to spend the rest. Putting funds towards your goals first lets you spend the rest of your money guilt-free, knowing that you've already taken care of the important stuff. The purpose of a budget should be to balance what we want now and what we want most, to find a balance between the two. We often spend too much today and ignore our future self, but this way, that's impossible. And balance doesn't look 50-50, more like 90% today and 10% for the future, depending on your goals. And when we do allocate funds towards our goals, we need to make sure that it is invested properly and reflects our best interest. We want our money to work for us and not cost us in the long run. No matter how perfect your plan is, there will be times when it feels like things aren't going according to plan. No one knows exactly what will happen in the future, and despite our best efforts to plan for everything, life will inevitably throw a curveball our way. These times will likely happen during market downturns, which have happened countless times throughout history, and we shouldn't expect the future to be anything different. But a good plan should account for everything. Although we don't know when downturns will happen, you can still account for them by using conservative averages and adjusting your asset allocation accordingly as your goals approach. We know that the best thing we can do as investors is to invest for as long as possible. That's absolutely going to mean investing through recessions, down markets, and times of uncertainty. But those things are all normal, and the global economy has recovered from every recession it's ever faced, and not only recovered, but has gone on to set countless new all-time highs. When you know exactly what to expect and exactly what to do, everything else becomes background noise. You can completely block out FOMO and focus on what actually matters. Investing often pulls against our gut instinct, and our behavior is really what dictates whether we are investors or not. If our behavior doesn't allow us to invest, or sabotages our attempts to invest, it doesn't matter how much we know or what we're trying to do. But if our behavior is aligned with what's required to be a successful investor, it can allow us to implement every advantage available to us, bringing our goals closer to within reach. Something that we can do to make the right behavior easier is make investing relatable. If we look at our day-to-day lives, the rules that govern our behavior are clear and obvious. But when we impose the same principles to investing, often our default is thinking that the world of investing requires different rules. The law of averages is a simple way to have a baseline of what to expect in the future. We know and accept that streaks, whether hot or cold, unlucky or lucky, come to an end, and have a way of evening itself out. But with investing, when a stock gets hot, we expect that it will go on forever, contrary to how everything else works. Instead of believing that investing defies the rules that tie together the rest of our world, we have to understand that those individual concepts operate in the same way that the rest of the world does. Similar to how our defaults can make us bad at planning, the things that make us most human are some of the things that work hardest against our ability to be successful investors. We tend to have a negativity bias, focusing and prioritizing the negative things around us. This can make us feel pessimistic about anything, and discourage us from doing the right things before we've even begun. Loss aversion can make us afraid to lose money, forcing us to sell and get out at exactly the wrong time, but it can also make us hold on to losing investments, unable to realize the hole that we're in and cut our losses. We tend to make decisions not based on what the optimal decision is moving forward, but based on what we've already put in or its sunk cost. This can all be driven by the fact that we tend to respond more positively to information that aligns with what we want to happen. But if we let our want for it to happen outweigh our rational thinking, it can cause us to make decisions that do far more harm than good, and we may find ourselves in a hole that we continue to dig deeper and deeper. Herd mentality refers to when we adopt the beliefs, behaviors, or attitudes of a group at the expense of our own judgment. When we jump into something without knowing what that something is, it rarely goes how we hope that it will. Our defaults can misguide us, and the truth is that they often do. A misguided belief can quickly become an overconfident certainty, at least in our minds, and can even more quickly become a disappointing reality. All of these things are pretty obvious when we think of them outside of investing. If we grab a hot pan, we don't hold on hoping it'll cool off, we simply let go. We make a best decision looking forward, not looking back. We might be far from being the perfect investor, but the good news is that we don't have to be. The majority of the biggest influences over our lives have been completely out of our control. We have no control over when we were born, who our parents are, where we lived, or our financial situation growing up. But those things play a significant role in our lives and shape us into the people we are today. The course of our lives can also be influenced by the luck that other people experience. Something as simple as when we were born can have incredible influence over how we're likely to view something, like how the stock market works or how inflation influences the world around us. Our behavior is influenced by so many things that are so far beyond our control that it really comes down to luck, both good and bad. We need to acknowledge the role that luck plays and also question the type of luck that we've received, and figure out how it influences our lives, and if we're giving it the weight that it actually deserves. Instead of dwelling on what we should have done differently in the past, I believe it's better to say that the best time to start investing is right now. It removes the past from the equation and instead focuses on what we can control and do moving forward. Beginning to invest at any age can provide a significant advantage over continuing to not invest at all. Even if you don't start investing until you retire, you can still allow your money to work for you, potentially significantly increasing its value. Historical data shows us that perfect market timing is increasingly impossible over any length of time. And instead, having regular contributions or investing funds once you have them have produced results almost as good as the impossible perfect timing. We can achieve incredible results by spending very little time thinking about what we need to do. This allows us to spend more of our time, our most valuable resource, in our most ideal way. The only real loser when it comes to investing is the person who decides not to invest at all. An important realization for our investments, and I'd extend this to our mental health, is realizing that no one cares as much as you do. We often spend money in a way to try to impress people, but everyone is too worried about themselves to be impressed by anyone else. We might be impressed by a thing, but not a person. We want that thing, but we don't want to be that person. We might see someone who has something we want, but it doesn't give us any insight into their financial situation. Did they buy it in full? Is it a reasonable purchase when considering their income, savings, or net worth? Or are they drowning in debt, living paycheck to paycheck? Spending money to show people how much money you have is the fastest way to have less money. When we are spending money in this way, all we are doing is moving ourselves further away from our goals and what we want most. Our own happiness comes down to our reality minus our expectations. When we know what's important to us, we can consistently work towards those things and use our money with intent instead of regret. When we don't know what will make us happy, it's easy to believe that anything is the answer. But until we define what will make us happy, we'll be in a constant cycle of chasing without ever arriving there. As long as we're investing in a properly diversified way that's aligned with our goals and risk tolerance, there's nothing that the markets can do that will cause our demise as investors. The only thing that can cause us to go off rails is our own behavior. This can be a tricky thing to wrap your head around, but once you do, it's a complete game changer. You by no means need to be an expert. Even a little bit of understanding can go a long way to creating the success that we are hoping for. But we have to understand what our obstacles are, what the solutions are, and how we can put ourselves in the best environment to be successful. Investing can be as simple or as complicated as we want it to be. By identifying what matters most, what's within our control, we can focus our energy on what will actually create a positive influence over our lives. In order to invest for as long as possible, we need to put our investments out of reach in a position where we remove our dependence from them. If we are constantly in a position of withdrawing from them, we are going to erase any progress we make with compounding and could actually deplete the principal as well. So not only are we not moving forward, we're actually moving backward. Mistakes made with our money not only have financial consequences, but it can create stress, anxiety, and make behavioral changes that stop us from doing the correct things in our future. Lucky for us, and unlucky for them, we can learn from the mistakes of other people. A lot of mistakes come from trying to force long-term results over a short period of time. This usually requires us to risk what we have and need for what we don't have and don't need. And when we approach investing in this way, it closer resembles gambling and rarely goes how we hope. Investing success is much more about avoiding big mistakes than it is about making great shots. It's an endurance sport where our number one objective is to survive. Compounding takes decades and decades, so a return in a specific year won't make our dreams into an overnight reality. But making mistakes can quickly take our dreams from probable to impossible. We can never avoid market risk. It's the price we pay as admission for being investors. And the good news is that we don't have to. In the short term, volatility looks like ups and downs. But when we zoom out to see the bigger picture, we see the pattern we want, up and to the right, with our assets increasing in value. When we invest properly, we don't have to worry about losing all of your money. But it's a probability when we're gambling. So we want to make sure that we are truly investing and not just tricking ourselves that we are. By understanding what our actual risks are, we can have a better idea of what to look out for, what to avoid, and what to focus on. By focusing on the right things, We can manage our own risk by not needing to know what will happen, but by being prepared for anything. To better understand the power of compound interest, we can look at this chart, which shows the months required to hit each $100,000 interval, from $0 to $1.7 million. Each interval is reached quicker than the one before it. This helps illustrate the power that time has on our investments, and our want to invest for as long as possible. In order to do that, we need to approach investing in a way that ensures our portfolios survive whatever comes its way. In order to achieve this, we want to invest in a diversified approach, not putting all of our eggs in one basket, and instead investing in dozens or hundreds or thousands of companies across the globe. By spreading our funds across many different companies, we reduce our portfolio risk and ensure that our financial success isn't dependent on any particular company. As we've seen in the past, even huge industry-leading companies have gone out of favor, resulting in terrible outcomes for heavily dependent investors. Study after study shows that diversification is a key to long-term success, being the most important factor. When we own everything, we already own the winners, so we don't have to worry about keeping up with the trends or subject ourselves to news headlines and opinions of those playing different games than we are. Instead of trying to manage returns, we want to manage risk, knowing that if we do so correctly, we'll give ourselves the timeline we need to be successful. Remember, the less time we have to spend on our investments, the more time we can spend pursuing what matters most to us. Even with the right investment approach in place, we need safeguards between us and our investments, providing alternatives to having to lean on our investments before we need them. We never want to interrupt compounding, so our investments should be looked at as a last resort. Being in the habit of spending less than we make, establishing an emergency fund and having flexible savings, having access to an appropriate amount of insurance through our employer or through personally owned policies, can all provide the resources we need. Since we all have different financial situations, it can be dangerous to assume something is enough. We want to understand our situation and be confident in what we have. Thinking about what can go wrong doesn't make it more likely to happen. It gives us more time and power to prepare for what life could throw our way. We tend not to want to think about what can go wrong, but the irony is that the people we're most doing a disservice to are ourselves and those closest to us. At this point in the course, everything is helpful in helping us behave the right way, on the bigger journey towards our success. When we don't understand something, anything can seem scary or out of the ordinary. This can cause us to make irrational decisions that we later regret. But when we understand how something works and what's reasonable to expect, we can make better, more informed decisions. It puts us in a better position to be able to differentiate between what does and does not matter. And if we're able to do that, we can spend more of our time focusing on the things that matter, while ignoring the constant noise that wants our attention. When we tie this into our values and what matters most to us, the best choice becomes the obvious one. Although we don't know what will move the needle the most in the future, managing risk is all about giving our future self options. We want to put ourselves in the best position to effectively deal with any problem or situation that arises. Whether you're Canadian or not, you likely have options available to you that will make reaching your goals easier. In Canada specifically, we have different account types, like an RRSP, TFSA, and non-registered account, that each have their own advantages and disadvantages, and can significantly make reaching our long-term goals easier. We can also use the same accounts for short to medium goals, or other accounts like the FHSA or RESP. Again, each account has specific advantages that make reaching specific goals easier and more effective. It's also important to understand the differences between the two most common pension plans people have access to through their employer, either a defined benefit or defined contribution pension plan. And having a better understanding of how CPP and OAS work can help us have a better understanding of our baseline government benefits during our retirement. Although it's not significant, they can go a long way to ensuring our future and all the goals that come with it are within our reach. A significant amount of confusion arises from the investment options we have available to us, and rightfully so. Things are often more confusing than they need to be. but understanding the differences between what options we have can allow us to ensure our money is in the best position possible to work for us. Remember, it's about doing the right things for as long as possible, so we want to ensure that what we have working for us is optimized and not sitting idle. And finally, we have to understand that buying a home isn't a right. It's something we have to work towards and earn. Luckily, the work required isn't complicated at all. You want to do things that make you look like a safe borrower, that you're in a position of low risk, and you have every probability of making your mortgage payments on time and in full. You want to be the type of person that you would feel comfortable lending money to, with the confidence that you would be able to pay yourself back in full and on time.